The first green candle doesn't look dangerous, it looks like oxygen. You've been watching a red grind on the 1 minute, a tight coil on the 5 minute, RSI curling off oversold, bid stacking on level 2. Then pop. A bright green body snaps above a tiny inside bar, volume ticks up and your cursor floats over the entry button. Your stop loss is right there below the wick. You convince yourself it's a clean price action reclaim of support. You imagine a squeeze, you imagine being early, you imagine screens of profit. Your breathing narrows with the flicker of the candlesticks. Dopamine flickers with them. You press it. The very next candle wicks you in, stalls and turns. Suddenly that neat stop loss feels too tight, so you nudge it. Then you pull it. The green that promised relief becomes a red that demands tribute, and you tell yourself the higher time frame still looks fine. As if time frames accept bribes. Minutes later, you're flat, annoyed, and scrolling TradingView for the next first green fix, as if the market owes you a do-over. It doesn't. It never did. Why does the first green candle trigger some of the worst entries you'll ever take? Because it collides with how trading belief systems form under stress. When price prints red after red, your brain builds a narrative to remove discomfort. It hunts for any counter-evidence that the pain is about to end. Mark Douglas called this the trap of distorting incoming information. To protect an expectation, your mind literally edits the tape when you want relief more than you want truth. In that moment, the first green candle isn't data, it's anesthesia. Brett Steenbarger warns that when boredom and loss aversion combine, traders seek P and L juice, not valid setups. A tiny pulse of green masquerades as signal. Confirmation bias zooms in, and you start seeing micro-reclaim patterns that aren't their chart pattern hallucination. Then your amygdala engages the fight or flight switch. Cortisol rises as soon as the candle stalls, and your decision quality drops with it. The more you stare at the level 2 for social proof, look buyers, the more mirror neurons amplify any aggressive prints, and you convince yourself other traders see the same thing. They probably don't. Meanwhile, the real auction is still imbalanced to the downside. Options put/call is elevated, breadth is weak. Volume profile shows a fat node above price with trap longs. And your first green is just a liquidity grab into resistance. The trading paradox makes it worse. The best entries rarely feel good. They feel lonely. But the first green candle feels amazing. Perfect, so it fails. The more analysis you do on that one candle, MA reclaim, micro RSI divergence. VWAP kiss, the worse your execution becomes, because you're analysing a noise sample as if it were a population. Tighter stops placed just under that seductive wick get hunted, because everyone clusters there. More screens, less clarity. You zoom from the 1 minute to the 15 to the hour, collecting reasons to press the button, while the only reasons that matter, context, participation, location, aren't there. Douglas's probability mindset from trading in the zone is absent. You're trading one outcome you need, not a distribution you accept. There's a costly pattern here that blows accounts in slow motion. It starts with exit greed extension on prior trades you held too long, gave back gains and swore you'd be quicker next time. Then a red sequence dents your P&L and identity. Revenge trading loops awaken. You tell yourself you'll only take A setups, but A slides to anything green. You fire the first green, get tagged, double down on the next green, because this one's the real one. And when that fails, you overcorrect into hesitation paralysis, missing the actual reversal that breaks structure with participation. You end the day with more trades than rules. Over weeks, the stop-loss removal syndrome expands first from a tick to a bar, then to a pivot, then to, I'll wait for the higher time frame to bail me out. The drawdown deepens. The Sunday plan says enter on pullbacks to prior day's value with trend confirmation. But Monday becomes enter on first green because I can't stand more red. Market wizards are full of these pre-explosion patterns. The pros who blew up didn't explode on one decision. They frayed on many tiny, just this time decisions, each anesthetized by a small green. Meet Marcus, the risk manager. He doesn't think in stories, he thinks in position sizing and risk envelopes. 2 to 10 trades a day across futures and large cap equities. But his edge isn't prediction, it's rule-driven risk expression. He starts on the daily to map structure. He draws the obvious: prior day's high/low, weekly VWAP, value area, high/low. And high volume nodes. He tags liquidity pools where obvious stops live. He notes macro context index breadth, dollar, crypto risk tone, and he writes a single sentence per symbol. Bearish below yesterday's value unless acceptance above VWAP, with 30-minute close and expanding delta. On TradingView, he color codes timeframes. The 5-minute is never allowed to override the hourly. Before the bell, he sets alerts at the levels that matter, so screens don't seduce him into chasing candles that don't. Marcus tracks his P&L, but only to monitor behavior. He has a first green trap checkbox in his journal. If he clicks it twice in a week, his maximum position size auto reduces by half for the next 5 sessions. That's not punishment, it's a circuit breaker. He uses a simple flow filter inspired by order flow pros. He won't touch reversal longs unless 3 of 4 are true delta expansion. Aggressive buyers lifting offers across 2 prices, a 5-minute close reclaiming a key level, and a failed breakdown that leaves a long lower wick into a prior liquidity pocket. He treats the first green as a scout information, not invitation. If that scout candle forms inside a resistance cluster and below VWAP, it's tagged as counter context, which requires either lower size or no trade. He prints this on a card taped to his middle monitor. First green is bait unless location plus participation plus structure. When Marcus gets tagged, he does nothing for 3 minutes. Literally nothing. He turns his chair, looks out the window, and resets his breathing. In 4, hold 4, out 6. That deliberate downshift lowers the adrenaline spike, so his next decision isn't a cortisol-smeared lunge. He embraces Douglas's core. Every tick is uncertain. His job is to define risk and let the distribution play out. On days the tape trends clean, he adds with a trailing stop below higher lows. On chop days, he takes a base hit and withdraws. Risk defines the trade is written in his notes, not as a quote but as a sizing function. His risk unit is fixed. Entries vary. Exits are pre-committed. He isn't married to candles, he's married to his risk plan. And he's not a robot. He journals like Steenbarger's performers. What triggered urge, what he saw, what he missed, how he'll train it tomorrow. Rewiring the first green reflex isn't about more indicators. It's about rebuilding processes so your brain doesn't need relief trades. Start with a pre-market anti-FOMO routine. Write the 3 conditions that must be present before any reversal long. 1. Higher time frame location. Favors longs or a fresh regime shift is signaled. 2. Structure breaks a higher low after a capitulation wick or a reclaim of prior day's value with volume. 3. Participation confirms aggressive buying sustained beyond 1 bar. Put the opposite on the screen in bold. A single green bar is not a reason. Then replace the habit loop. When you see the first green, do not click. Tag it, scout, and set a limit at the first pullback into a micro HL that forms after buyers prove they can defend a level. If it leaves without you, good missed trades are wins if the process was honoured. Add a sizing governor. If you ever take a first green entry against plan, your next 3 trades max at half size. If it happens again that day, you're done. No debate. Build an alert grid so the market calls you to valid setups instead of you chasing impulses. Alert on reclaim of prior day's value. Alert on cumulative delta crossing 0 after long distribution. Alert on 15-minute RSI exiting a deep oversold while price holds a reclaimed level. Use a checklist from the way to trade. If the system doesn't fire, you don't trade. System traders survive because they define exactly what a valid entry is and execute mechanically. Hybridize. Even if you're discretionary, execute like a system at the moment of decision. Train the nervous system. Before the open, rehearse the trap in vivid detail. Watch a recording of your worst first green chase. Pause at the button hover. Feel the heartbeat, then rehearse the alternative behavior, name it out loud. Scout only. Breathe, wait for proof, or let it go. Mental reps reduce the cortisol surprise when it appears live. Journal with Mark Douglas's probability lens. Write how many first green traps you avoided this week. Count non-trades saved. Your brain needs wins that aren't P&L to weaken the relief trade addiction. Keep a scoreboard, traps avoided, stops respected, plans followed. Reward the process, not the candle. Finally, embed the paradoxes so they become instincts. The best trades will often feel uncomfortable, buying the second pullback after the first clean HL when Twitter says bear market rally. The more you analyze a single candle, the worse you'll do. Zoom out, ask who's trapped, and where is acceptance. The tighter your stop under the same obvious wick, the more often you'll be wicked out. Place it where your trade thesis is invalid, not where your fear is soothed. The more screens you watch, the less you'll see. Mute the noise, elevate the alerting. Here's the picture on the other side. Marcus is watching a name crater into prior week's low. The 1 minute prints a first green with a juicy lower wick. He doesn't touch it. VWAP is above, value above, and the order flow shows buyers lifting once, then fading. The second attempt pushes lower and tags the liquidity pool. This time a washout spike hits, sellers exhaust, delta flips, and a 5 minute closes back inside yesterday's value. Alert fires, reclaim plus participation. He sizes a starter, places a stop where the reclaim would be invalid below the failed breakdown, not under the last candle's wick. The next red pullback holds a micro HL, he adds. He's calm because his process reduces decisions to checkboxes. He knows most traders lose money, and that past patterns do not guarantee future results, so he respects his stop without story. He's not chasing green, he's trading context. When price reaches the high volume node overhead and order flow stalls, he scales. If the move truly transitions to mute trend, breadth improves, VU upholds, higher lows build, he leaves a runner with a trailing stop. If it doesn't, he's out. No drama, no neediness. Just risk expressed cleanly. You don't have to be Marcus to stop donating to the first green gods. You do have to let go of the idea that candles will save you from feelings. Markets don't care about your relief. They care about auction. Treat the first green like a rumour. Interesting, never sufficient, often deceptive at the exact moment your brain most wants to believe. Replace the reflex with a rule. Location first, structure second, participation third, execution fourth. Replace the hope with a plan. Alerts, checklists, sizing governors, and breathing breaks. Replace the story with statistics. Track traps avoided, not just dollars earned. This is not financial advice. It's trading hygiene. Risk management is survival. Most traders lose money because they chase the feeling of finally, instead of the facts of order flow and structure. When you stop trying to feel better with a green candle and start trading better because a system told you so, the worst entries fade. The market won't change. Your brain will. And when that happens, the first green becomes what it truly is. Information you're free to ignore until the trade is real.